A single decision can raise your rent and drive up your monthly payments. It's the system doing what it was designed to do: change the price of money and make your life more expensive on purpose. When people hear interest rates, they think it's a topic for bankers, economists, or investors. But interest rates aren't niche. They're the thermostat of the entire economy. Turn it up or down, and the whole house changes temperature. And the strange part is this: you usually don't feel the change immediately. You feel it later, as higher payments, higher prices, and fewer opportunities. Here's the simplest way to think about it. Interest rates are the price of borrowing money. If money is cheap, borrowing is easy. People buy homes, businesses expand, investors take risks, spending rises. If money becomes expensive, borrowing gets harder. Big purchases slow down, businesses hesitate, hiring cools, spending drops. So when rates rise, it's not just loans get pricier, it's that the entire system starts to move differently, like traffic after a lane closes. If you have a credit card balance, a variable rate loan, or you're financing anything, a rate increase can raise your payment without you buying a single extra thing. Even fixed-rate loans aren't immune, because when new loans become more expensive, the new normal becomes higher. That changes what people can afford, and that changes the market. This is why rate hikes can feel personal, like the system suddenly got stricter. Higher rates make mortgages more expensive. That sounds like it should lower home prices, and sometimes it does. But here's the twist. When mortgages get expensive, fewer people can buy. Many stay renting longer, and more demand stays trapped in the rental market. At the same time, landlords and developers often face higher financing costs too, so new construction slows down. So that one decision can hit you whether you rent or own, just through different doors. When rates rise, businesses pay more to borrow, so expansion plans get delayed, budgets tighten, hiring slows, raises become harder to justify. It's not always layoffs. Sometimes it's quieter, fewer openings, longer job searches, more experience required, and slower wage growth. Rates don't just change prices. They change confidence, and confidence is what companies spend first. So why raise rates at all? Because when spending runs too hot, prices rise faster. That's inflation. Rate hikes are basically a brake pedal. They're designed to cool demand and slow price growth. The system isn't trying to punish you. It's trying to control the speed of the entire economy. But you still feel the braking force in your own life. Here's the takeaway. When rates change, don't just ask, what happens to loans? Ask, where does expensive money show up next? Because once you can see the chain, you stop blaming yourself for the ripples you didn't create.